tough times never last, but tough banks do. And the U.S. banks are tough. They are resilient. This is night and day versus the period around the global financial crisis. U.S. banks today have twice as much capital, much more liquidity, better underwriting of loans, better oversight, and more resiliency. So these are tough times. These are sobering times. You are likely to see higher loan losses, both in consumer and wholesale, but we think banks come out the other end without failing among the largest banks, without issuing new equity, and with earnings snapping back. I will say, as goes COVID, as goes U.S. bank stocks. Yeah. So to the extent that the COVID situation, which is likely to be very bad, it's likely to be a very dark winter for COVID in the U.S., but come the middle of next year, the experts that we rely on say we should be closer to normal. So if that's the case, then there is a lot of upside for bank stocks in the U.S. over the medium term. And one point that I'd point out here is that when the Pfizer news came out last week, a week ago Monday, U.S. bank stocks had their best day relative to the stock market since April 9, 2009. It was the best day in over 11 years for U.S. bank stocks when news of the vaccine first came out. So that is the hope for the U.S. bank stocks. In the meantime, banks in the U.S. have the wherewithal and record reserves at this stage of a recession to absorb the problems in the near term.
You know, though, Mike, in a note that came out from S&P that was looking at some of the credit risks going forward for the sector, though, I mean, they still warned that we're not likely to see a full recovery for the sector until perhaps 2023 or beyond post-COVID. I mean, do you think that's reasonable?
Well, there's a big difference between the building up reserves for the problem loans in the U.S. and the actual losses that are charged off. And so in the first half of this year, you had a record level of protection against these problems that are to come. And the protection, or what's known as provisions for loan losses, already hurt the earnings. So when the actual losses come over the next 1 to 2 years, and they will go higher, that won't be an earnings event. Banks have already protected themselves against that. So I think that's the point that's the most underappreciated, is the resiliency of the banks. And look no further than the U.S. bond market. The $6 trillion investment grade U.S. bond market says that U.S. banks are among the riskiest from a default standpoint of any industry. So there's a disconnect between the bond market in the U.S., which says banks are extremely safe, and the stock market, which says that banks are extremely risky. And just like during the global financial crisis, the bond market was right, the stock market was wrong. Likewise, this time we think the bond market's right, and the stock market's wrong in underpricing U.S. bank stocks as much as they do.